Welcome to The Explainer, where we take on the big, complex topics and, well, we explain them. So, let's dive into a real economic mystery that's happening right now. For months, gold has been hitting record prices. But here's the crazy part. Everything that should be making gold cheaper is happening, and yet its price is soaring. The playbook investors have used for more than 50 years, it's completely broken, and we're about to figure out why. Okay, so to really get a grip on just how weird this is, we've got to go back in time to see how gold's value used to work. And I promise this isn't just a boring history lesson. It's actually the key to unlocking this whole thing. All right, so picture this. After World War II, the entire global economy ran on a system called Bretton Woods. The US dollar was backed by gold at a fixed rate, and all the other currencies were tied to the dollar. Seemed simple enough, but by the 60s, US debt and rising inflation started to show the cracks in the foundation. And then, boom, 1971. President Nixon makes a move that sends shockwaves around the world. He completely cut the link between the dollar and gold. And just like that, the modern gold market was born. So in this brand new world of floating currencies, gold basically got a new job description. It became the ultimate safe haven asset, the place you put your money when things get chaotic. And almost right away, its price started doing this little dance, perfectly in sync with one super important economic signal. And that signal? It's something called real yields. It's actually a really simple idea, but it's so powerful. Let's say you buy a safe government bond and it pays you 5% interest for the year. Sounds good, right? But wait, if inflation, the cost of everything going up, is at 3%, then your real return, the actual extra spending power you got, is only 2%. And that is your real yield. And this, right here, this is the old rulebook in a nutshell. So think about it. If real yields were super low or even negative, holding a bond literally meant you were losing money every day to inflation. Why would you do that? In that situation, gold, which doesn't pay you interest, sure, but it holds its value, suddenly looks really good, so its price goes up. On the flip side, when real yields were high, you'd rather take the guaranteed return from bonds, so gold's price would fall. For half a century, you could set your watch to it. It was like a seesaw. Real yields up, gold down. Simple. I mean, for decades, this wasn't just a rule, it was the rule, the bedrock of how everyone analyzed gold. You wanted to know where gold was going? You looked at real yields. End of story. But then, well, the pandemic hit, and that fundamental law of financial physics it shattered. And look, this isn't just a theory, we've actually got the data to back it up. There's this really detailed study that came out of the University of Malta just last year, and they put this exact relationship under the microscope. They looked at all the numbers before and after the pandemic. And what they found, well, it's a total game changer. So first, the study confirmed what everybody already knew, or at least what they thought they knew. Looking at the data from before 2020, the relationship was exactly what you'd expect. Strong, clear, predictable. Real yields went up, gold went down. The old rulebook worked like a charm. But then, and this is the real kicker, when they ran the numbers for 2020 and beyond, that connection, poof, gone. It just completely vanished. The relationship became, as they put it, non-significant. The old playbook wasn't just a little off, it was totally useless. Okay, so this is the real core of the mystery we're trying to solve today. Because right now, as we speak, real yields are high, like really high. The kind of high that, based on the old rules, should have sent the price of gold plummeting. But instead, it's flirting with all-time records. So what gets? If real yields aren't in the driver's seat anymore, who is?
Thank you for watching. Please like and subscribe to our channel.
Well, you know that same study that blew the whistle on the old rules? It also gives us some pretty big clues about what the new rules are. And it looks like a completely new playbook is being written for gold as we speak. And here's the big takeaway. The new drivers aren't these tidy little economic formulas anymore. They're huge, messy, global trends. First, you've got central banks around the world, especially in emerging markets, buying up gold like crazy because they want to hold less in US dollars. Second, there's just so much geopolitical risk out there. Conflicts, instability, and when the world feels unstable, where do people run? They run to safety. And that all feeds into this third driver, persistent demand from everyday investors who are just looking around at this crazy, uncertain world and thinking, you know what? Gold feels safe. Gold is real. And believe me, this demand isn't just some abstract idea. The numbers here are just wow. Just look at last July. Investors shoveled $3.2 times billion into funds that are backed by gold. That's in 1 month. That's a massive, real flow of money that tells you just how much power these new drivers have. Okay, so we've established it. Gold is playing a whole new ballgame. But what does that actually mean for you, for me, for anyone just trying to figure out where to put their money or just make sense of the global economy? Well, it's not just the why of gold's price that has changed. The how of investing in it has evolved too. It's not just about buying a few gold coins anymore, or even just buying stock in the big companies that do all the digging. There's this other model that's getting a ton of attention lately, and it's called royalty and streaming. The best way to think about them is not as miners, but as the bankers for the miners. They're the smart money. Instead of dealing with all the risk and the soaring costs of actually operating a mine, they give the miners cash up front. In return, they get to buy a percentage of all the gold that mine produces in the future, but at a fixed, super low price. It's a really clever business model, right? You get the upside of a rising gold price without the headaches of, rising fuel costs or labor strikes. And is this model working? Oh, yeah. It is absolutely crushing it. You look at the big players. Franco-Nevada, reporting record-breaking revenues. Wheaton Precious Metals, they generated over $400 million in cash in just 1 quarter. And Triple Flag just hit their own all-time high. These guys are absolutely thriving in this new gold era. So, all of this complete breakdown of a rule that stood firm for 50 years, it leaves us with one last, pretty provocative question to think about. You see, that relationship between gold and real yields, it wasn't just some random data point. It was a pillar of stability. It was predictable. And now, that pillar is gone. So if something as ancient, as fundamental as gold isn't playing by the old rules anymore, what does that say about the rest of the financial system? It really makes you wonder if we're sailing in completely uncharted waters, and all our old maps are now totally useless.